Hello, everyone, and welcome back to another episode. I'm your host, the Millennial Investor, and today we're going to go over the big banks reporting earnings. And the four that we are going to focus on is Wells Fargo, JP Chase, Citigroup, and Goldman Sachs. So in this video, we're going to go over the reports of all four of these big banks. The only one that I own in this portfolio is JP Chase, the largest bank in the world, and they did crush earnings. And quite frankly, if I'm going to be honest, it was just a lot better than I expected it to be. And the same goes for all of these banks. They really did blow us out of the water with the exception of Wells Fargo. And I will be going over that. Those of you that know me that watch my channel, I did just sell Wells Fargo maybe a month, 2 months ago, and I did suspect that a dividend cut as well as some earnings misses was probably going to be happening. So if you don't know me and you don't know who I am, my name is Jordan. I'm the Millennial Investor, and I primarily focus on dividend investing. I use these charts to track my annual dividend income, my monthly dividend income, and my portfolio value using this information here. This is the 31 companies that I own right here, and this is how much they pay me on an annual basis. And this is my annual dividend income, this is my portfolio value, and this is what I received last month from monthly dividends. But for what I do, since I'm a dividend investor, what I do is I primarily focus on long-term blue chip companies, and that's why I invest in JP Morgan. So that's why I wanted to cover this in this video. And one more piece that I will be covering in this video that did go off quite a bit was this Tesla video that I posted on. I had so many comments reaching out to me. Some were so extreme to the bullish side of Tesla, and some were so extreme to the bearish side. But there was one comment here specifically, this one by Mark, that I will be going over at the end of the video. So if you're interested in that, go ahead and stick to the end. And speaking of the end of the video, I will be updating you guys on my portfolio on a stock per stock basis. So go ahead and stay for the end of that if you're interested in that. But overall, guys, if you're interested in signing up with M1 Finance, go ahead and check out the description in there. There is a referral link. If you get signed up through M1 Finance, they are an amazing brokerage. You can get $10 just for signing up. And there's lots of other information in that description as well that you need to check out. So even if you're not interested in signing up with M1 Finance, go ahead and check out the description because it is very, very important. And there's a lot of stuff that you can look at. But let's go ahead and get started with Wells Fargo. Now, if we go ahead and click my activity tab here, we sort by activity type, we hit trading only. We scroll down, you see the first sell in the portfolio. So May 18th. So May, June, July, that's almost exactly 2 months from the time I'm filming this. And you can see I sold Wells Fargo for $24.52 a share. So $24.52 if we research WFC. Today, Wells Fargo sits about 80 cents higher than that. So Wells Fargo is about the same price of what I sold it at. Now the reason why I sold it was primarily because of the dividend. I knew that more than likely if any banks were going to be cutting their dividend, I knew Wells Fargo was going to be one of them. So Wells Fargo paid out 51 cents a quarter in dividends, and now they only are going to pay out 10 cents a quarter. So if we take 10, we divide that by 51, and we minus 1, that means that it's an 80.39% reduction. 80% of your paychecks, 80% of your passive income is now lost through Wells Fargo. This is what happens when you have a company that has bad management, a company that does not run its bank or its business as well as its peers. And you notice here, the four banks that we're going to be going over, 3 of them beat earnings. And these are the largest banks in the world. These are not some Joe Schmo, no one ever heard of banks. These are the largest banks in the world, especially JP Morgan. Goldman Sachs, Citigroup, JP Morgan, all these guys crushed earnings. And then you have Wells Fargo. So let's go ahead and start looking at Wells Fargo and see how they did. Wells Fargo shares tumbled 5% after posting a $2.4 billion loss. Dividend slashed to 10 cents. The bank had a net loss of $2.4 billion in the second quarter, or a loss of 66 cents a share, worse than the 20 cents a share loss expected by analysts surveyed by Refinitiv. So to go ahead and point that out first off, the loss was over 3 times higher than what was expected than that of analysts. Revenue of $17.8 billion was also weaker than analysts' $18.4 billion estimate. The bank also announced the new quarterly dividend of 10 cents a share, a deeper than expected reduction in its payout that may indicate the bank's pessimism about the coming year. So you can go ahead and see that already here with Wells Fargo. It is not pretty. It is not looking good at all. And this is what I'm talking about. Those of you that didn't see my video about Wells Fargo, go ahead and watch that and it will really break down why I sold it and why I ended up making the decision that I did. I see things like this coming. When you have great management, they continue to make great management decisions. When you have horrible management, they continue to make horrible management decisions. Now, the reason I bought Wells Fargo when I originally started the portfolio was primarily just because I got in the habit of looking at that high dividend yield and thinking that they're going to be able to pay it out even in this recession. And then as I got further and further along, I just saw that that was not going to be the case. So I am not one to be a bag holder, and I'm not going to be one that has the sunk cost fallacy. I'm not going to hold on to a losing stock just because I don't want to claim a loss. I did sell some of my stocks over the last couple months. You can see I don't sell stocks very often, and when I do sell stocks, it's usually because of a change in management or a change in the dividend or just something in general that I don't like about the direction of the company. I didn't care about the price. All the stocks I've sold so far, I've sold in the green, except for Wells Fargo. I sold it for about a 10% loss. But let's go ahead and jump into JP Morgan Chase. So for JP Morgan Chase, shares jump after record trading revenue drives stronger than expected second quarter profit. Here's how JP Morgan did. Earnings of $1.38 a share, exceeding the $1.04 per share estimate of analyst surveys by Refinitiv. Revenue of $33 billion compared with a $30.3 billion estimate. Trading revenue surged 79% to a record $9.7 billion as bond and equities trading exceeding expectations. So let's go ahead and stop right there before I get further than that. So you see here $1.38 per share, and they were expecting $1.04. $1.38, that's about a 30-ish% beat. That is a massive beat, especially for a bank, especially the largest bank on earth. So one reason why this is so important and why I'm going over all four of these banks is that if these banks are going to kill earnings, that is going to be great for the economy and just the general quarter two reports for all stocks in general. And the same thing on the flip side. If they all miss earnings, if they're in the gutter, if they're doing horrible, it's going to hurt a lot of other stocks as well, and not just in the financial sector. It is going to hurt everyone. So seeing a 30-ish% beat in earnings per share, that is absolutely incredible. A revenue beat of about $3 billion is what they beat revenue on. That is incredible. And then you get to trading revenue was a 79% surge in trading revenue. That is incredible. So let's go ahead and get to the last two bullet points here. Bond traders posted revenue of $7.3 billion, a 120% increase from a year earlier, a year-over-year growth, crushing the $5.84 billion estimate by almost $1.5 billion. Equity traders posted revenue of $2.4 billion, beating the $2.07 billion estimate, a 120% increase from a year earlier. That is crazy. Just a company of this size and so many different customers that they have, 120% revenue growth in any category for JP Morgan I'm speechless. That was just incredible. Despite some recent positive macroeconomic data and significant decisive government action, we will still face much uncertainty regarding the future path of the economy, CEO Jamie Dimon said. Now, one thing that's really interesting here is that a lot of people listen to a certain number of people about the economy and where we're going in the direction that we're moving. Warren Buffett is a prime example, Jerome Powell is a prime example, whoever you want to look at. And then Jamie Dimon is definitely a key player in this space. He is the CEO of the largest bank in the world, and when he speaks, people listen to what he has to say. So overall, guys, with JP Morgan, I am very happy. And those of you that are curious, we go to my holdings here, and then we just sort by name. We scroll down to JP Morgan. Yes, right here. So JP Morgan, we are up about 11.4% on it, and we are doing very good, and I'm continuing buying this company even after its big move up from its earnings, because you can see with JP Morgan here, if we click the chart and we look how it's been performing, the last week has been very nice for JP Morgan. You can see that huge jump up there with the earnings beat, and they are almost back up to $100 a share. So they're recovering quite nicely compared to where they were just a couple months ago. So JP Morgan, definitely be buying more of that. So let's go ahead and jump into Citigroup, the next stock. Here's how Citigroup compares to the other banks. Citigroup reports better than expected earnings on strong trading results. Earnings of 58 cents per share versus the 28 cents per share expected. Revenue of $19.77 billion versus $19.12 billion forecast. Fixed income, currency, and commodity trade revenue of $5.6 billion versus $4.86 billion forecast. Now, first of all, you can see this category here. The same thing pretty much of what JP Morgan reported with their massive increase in trading revenue. They did have quite a bit of a large beat as well, at 5.6 versus a 4.86. That is almost a full $1 billion difference. Their revenue was about $500 million higher, so a decent beat there. And then earnings per share came in quite a bit better than expected, of 22 cents higher than that of what it was expected. So that's pretty great for Citigroup. Citigroup is not one that I own, but overall it's good to see that they're just being more profitable and just putting up better numbers than that of what was expected of them. So let's go ahead and look at the last one here. Let's go ahead and look at Goldman Sachs. Goldman Sachs shares jump as earnings blow past the Wall Street on the best trading results in years. Goldman said it generated $2.42 billion in profit, or $6.26 a share, crushing the $3.78 a share estimate of analysts surveyed by Refinitiv. Now, first off, let's look at that first little bullet point there. 2.42 billion in profit, $6.26 a share, crushing the 378. So they were expecting 378, but the bank reported 626. Now, I probably should have mentioned this earlier in the video. Those of you that are new to the stock market that are trying to learn more about what this means, how earnings works. So basically, when you report EPS or earnings per share, which is this number right here, 626 and 378. So basically what that is, 626 is for every stock that's out there. Basically, let me go ahead and look that up. So let me look up GS. So Goldman Sachs, if we look over here, the stock is $217 a share. So basically for every share that is publicly traded in the stock market, they made about $6.26 in profit, pure profit. That is not revenue, that is not any kind of loss, that is $6.26 of pure profit per share. So that is earnings per share. So a 378 versus a 626, that is almost a double up. So that is an incredible beat by Goldman Sachs, and I think that is great for the economy. It was the New York-based bank's biggest earnings outperformance in nearly a decade. Revenue of $13.3 billion was more than $3.5 billion higher than the estimate, fueled by strong results in its trading and investment banking decisions. You can see the same thing here. A lot of the trading revenue is a lot higher for all of these banks, Goldman Sachs following suit as well. Bond trading revenue surged almost 150% to $4.24 billion, and equities trading revenue rose 46% to $2.94 billion. Together, the trading division produced roughly $2.5 billion more than expected. So $2.5 billion more than was expected. They've reported $4.24 in total and a 150% revenue increase in bond trading revenue. That is absolutely incredible. Just when you think that the 120% by JP Morgan is pretty crazy, you see Goldman Sachs reporting a 150% beat. So seeing a beat of any bank of this size in any category, like I said, is absolutely incredible. And you can see the video there up 4% from the time they reported these earnings. So that is great to see. And overall, just generally speaking, between all four of these banks, I'm really happy to see that they are beating earnings. And the reason is because if these stocks beat earnings, it's likely that a lot of other stocks are going to beat earnings, and they definitely set the tone for how the economy is moving forward. Like I said, for a lot of big weighted stocks, like if Apple beats earnings, that might rise the economy and that might rise the S&P 500 because they have such a large weight. But with these big banks, they definitely set the tone. They set the direction of where we're going in our financials and the backbone of the economy, because they're the most important for all this. So overall, guys, the banks did very well, with the exception of Wells Fargo, what they always miss pretty much. But the banks did very well, and I'm very happy with what they reported. So let's go ahead and jump into the comment that was left for me by Mark, and it was on my Tesla video. So those of you that don't know, I did make a video about Tesla. I put buy Tesla before it's too late. Regardless of whether you're a bull on the stock, you're a bear on the stock, just generally speaking, if you are interested in stocks and how they work, this has nothing to do with Tesla, what I'm about to say, and this is basically going to show you this incorrect comment that was left in my video and to show you how you actually value companies. Where's your math? Mark says. Exactly what expected profits are you using to calculate your reasoning for the future value of the stock? For a company to be worth 200 billion, that means you expect them to make 200 billion in profits. Justify those. Let's look at JP Morgan Chase, for example. JP Morgan is one that we own. So they have a $300 billion market cap. And now remember, that's after this recent drop. So when it was January, February, the beginning of the year, this stock was a $500 billion market cap. So today they're sitting at 300 billion. Now, look at this. So with revenue of 33 billion in the quarter, this is revenue. This is not profits. So that means if they were to match that for all 4 quarters, they would make about 120, 130 billion. Less than half of its market cap. So if they made, let's say, 100, let's call it 150. Let's say they beat earnings incredibly over the next 2 quarters. Let's say they made $150 billion in revenue. That means that the market cap would still be twice as much what the company reports in revenue. Not in profits, but just in revenue. So profits are not a representation of what the stock is worth. You can use a valuation, and that is what is called a PE ratio. So basically what this number is not updated very frequently by M1 Finance, so this might be a little bit off. But a PE ratio is a price to earnings ratio. Remember that earnings per share number that we talked about? So for JP Morgan, it was $1.38. This means that JP Morgan made $1.38 of pure profit for every share that is out there on the market. They have millions and millions, maybe even billions of shares out there, but they have millions and millions of shares, and that means that every share that was out there, they made $1.38 of profit. Now, when you see this 13.2 PE ratio, this means that if you take that $1.38 for the quarter and you multiply that by 13.2, that is what people are valuing the company at. So Square is a company that is, for an example, that is having an absolute incredible run. It is being valued at incredible levels. So basically, just based off of a PE ratio, not looking at growth, not looking at anything, this is trading at 168. So the higher the PE ratio, the more that the company is overvalued. So you want that PE ratio low. If people are valuing a stock at 168 PE ratio, they're expecting incredible growth, not over the next year, but over the next decade. So with a company like JP that doesn't grow as fast, it trades at a 13.2 PE ratio. But still, what this means is that people are paying 13 times higher than what its pure profit is. So to say that a company has to make 200 billion in profits for a company to be worth 200 billion is completely incorrect. That is not right, and that is what is called an earnings multiple or a 13 times earnings multiple. So to value this company, Mark, it is not valued based off of its earnings. Besides, speaking of Tesla anyway, it hardly makes any profit anyway. It is just becoming profitable here in the last year, and I don't think that this company is being valued in any way based off its profits. It's being based off of, one, the story that is behind it, two, the large growth ahead of it, and three, just all the different opportunities and emerging markets that they're going to be in with electric vehicles and a lot of other software and stuff like that. So overall, guys, that is my opinion on that, and let me know what you think down there in the comment section if I missed anything. But overall, guys, I'll give you a quick update on my portfolio. This is my annual dividend income, my monthly dividend income, and my portfolio value, and I did finally switch out Duke Energy right here, this little section right here, for Dominion Energy, and I will be updating these numbers at the end of the month. Every single month I do give an update on my portfolio and my dividend tracking, and you can see my portfolio right here if we get it pulled up. We did cross the 2,800 mark last night when the stock market closed, and if you see my best performance in the stock market here, my best performers are Whirlpool, Discover Financial Services, Apple, and NextEra Energy Partners, Home Depot, overall doing very good on a lot of these stocks. And if we go here to my worst performers, we are only down on 3 different stocks, and all 3 of these, especially these 2, are very new, and we have WP Carey, Starbucks, and Store Capital is what we are down on. I will be averaging down on these positions. I will not be selling any of them, and you can see a lot of my other holdings here if I sort by value highest, and we're doing very good on a lot of our top holdings. But overall, guys, if we go to my holdings here and we go on off a time-weighted return, we're now up 15.13%, 373 in gains. If we go on a money-weighted return, we are up 21.45%, 416.15 in total gains, 390.13 coming from market gain, and $25.02 strictly coming from earned dividends. And in my activity page here, we did just receive a dividend recently. We did receive one from Kimberly-Clark and from Altria Group, and then some other dividends in the past month as well. But overall, guys, we made it all the way to the end. Thank you guys for watching all the way to the end. Thank you guys. I love you guys so much. I'm about to hit 1,000 subscribers. And if you are one of the 16 people that have signed up using my referral link, thank you guys so much. And if you are interested in signing up for that, go ahead and check the description. It is down there below. And like I said, guys, if there's anything else that you want to know about me or want to send me an email, ask me any questions, want me to review your portfolio, whatever, there is an email down there below. And if you also want to schedule any kind of mentorship call, go ahead and check that out down below in the description. But thank you guys so much for watching. Leave a comment down below what you thought about this video, and I'll see you guys next time.